Hi everyone, thanks for tuning in to learn more about our QOZ Fund. I'm Ben Harris, the Vice President of Investor Relations, and I'm excited to be joined by Origin's co-founder, Michael Episcope, and Origin's General Counsel and in-house QOZ expert, Michael McVicker. The initial level of interest of more than $100 million in less than 24 hours speaks volumes about the intrigue with QOZ investments. And the goal of this webinar is to continue to build on what you already know. It will last about 45 minutes, and while we will briefly cover QOZ investing in general, the majority of the time will be spent on the specifics of our fund. Thank you to everyone who submitted questions in advance. We will address them towards the end of the presentation. Please note that we will not be doing a live Q&A, but you can certainly contact me afterwards if you still have additional questions. We'll kick off the webinar by discussing the QOZ basics, and then we'll talk about Origin's history, the benefits of our fund, the deals in our pipeline, then we'll answer the already submitted questions before addressing terms and next steps if you'd like to participate. With that, I'll hand it over to Michael McVicker to discuss QOZ basics.
Thanks, Ben. Before I begin, I just want to read a quick legal disclaimer. The information discussed today is for informational purposes only and is not intended to provide and should not be relied on for investment, tax, legal, or accounting advice. The contents of this presentation are not provided with regard to any investor's specific investment objectives, financial situation, tax exposure, or particular need. Nothing presented should be used as the basis for making any specific investment, business, or commercial decision. This is not an investment presentation, and you should consult your personal tax, legal, and accounting advisors before engaging in any transaction. The provision of any service or products provided by Origin Holding Company, LLC, or any of its affiliates is expressly subject to the particular terms and conditions contained in separate written agreements between you and Origin or such affiliate, as applicable. So now I can begin talking a little bit about what opportunity zones are and why they're generating so much interest. Opportunity zones are certain economically distressed localities that were identified by states and then certified by the U.S. Treasury Department. These zones have been created as an economic development tool designed to spur economic growth and job creation in low-income communities. The Treasury Department has certified over 8,700 opportunity zones, which makes them qualified opportunity zones, and these zones are in all 50 states, the District of Columbia, and 5 U.S. territories. Why is there so much interest in opportunity zones? It's basically because the Tax Cuts and Jobs Act, which was signed into law in 2017, created an opportunity for investors to defer capital gains realized from various asset sales if they invest those gains in a qualified fund that in turn makes investments in a qualified opportunity zone. In addition to that deferral, there's a potential forgiveness of a portion of the original gain. And on top of that, there's a potential forgiveness of any new gain. So I'll talk a little bit about that initial gain deferral. If you sell an asset to an unrelated person and realize a gain, and this could be a long-term or a short-term capital gain from the sale of real estate, securities, collectible, art, any sort of other appreciated asset, in that event, you can elect to defer recognition for tax purposes of an unlimited amount of those gains if you reinvest the gains within 180 days into a qualified opportunity zone fund, or QOZ fund. These funds are corporations or entities taxed as partnerships that have a stated purpose of acquiring and owning certain qualifying property in opportunity zones. The investment into a QOZ fund really benefits a long-term investment, and these benefits escalate the longer you hold your investment. So for example, in addition to the immediate deferral of taxes on your capital gains, you may also qualify for a basis adjustment in your investment. Your initial basis in your QOZ fund is zero since you've invested capital gains on which you've paid no taxes. But if you hold your investment for at least 5 years, your basis in the QOZ fund is increased by 10%. It's 10% of the original deferred gain. The effective result is a reduction of your original gain by 10%. If you hold your investment for at least 7 years, your basis in the QOZ fund increases by an additional 5% of the original deferred gain. And this effectively results in the forgiveness of a cumulative 15% of your original gain. The original gain, or the amount remaining after any sort of reduction based on the length of time you've held it, can be deferred until the earlier of the date on which the QOZ fund interest is sold or exchanged, or December 31st, 2026. If sold or exchanged on or before December 31st, 2026, you recognize tax on the difference between the original deferred gain, as it may have been adjusted, less your basis in the investment on the recognition date. Note that there's an imputed recognition event on December 31st, 2026. So if you still hold your QOZ fund investment on that date, you'll need to pay the capital gains tax on the balance of your deferred gain, or the deferred gain with the step-up in basis if you've held your investment for 5 or 7 years. In addition to the deferral and potential reduction in gain, an investment in a QOZ fund also has the potential to appreciate tax-free. If you hold the QOZ fund investment for at least 10 years, you can elect to step up the basis in your investment to its fair market value on the date the investment is sold or exchanged. This has the effect of permanently excluding income from all new capital gains arising from the QOZ fund on the date the investment is sold or exchanged. Investors who invest capital gains into a QOZ fund are eligible for the deferral and forgiveness we just mentioned, but investors can also invest non-capital gains into a QOZ fund, or a mixture of capital gains and non-gains. But if a mixture is invested, the investment will be bifurcated into 2 investments following the type of contribution that's made. One that's eligible for the QOZ fund tax benefits and one that is not. And that's my summary of what QOZ funds are and why they are generating so much interest. And with that, I will pass the mic over to Michael.
Thank you, Mike. Mike has become our resident QOZ expert. It helps us sleep at night knowing how adept he is at this law. I want to thank those who submitted questions in advance. One of my goals is to weave in those questions into the presentation. I'm not going to go through a whole FAQ at the end and answer those one by one, but hopefully when I'm done with my presentation, I will have answered your question, or at least gotten to. We saw a lot of themes behind them. One of the questions we get quite often, and it's no different with this fund, is will we be investing in this fund? And the unequivocal answer is yes. A minimum of $5 million we will be investing, and probably much more than that. My partner and I are getting together our gains and looking at this, but this is an amazing opportunity. And more importantly, we believe in our team and this fund and the investment strategy as well. Let me tell you a little bit about Origin, and then I'll go into the fund as well. And hopefully most people on this line probably know something about us, and I'm sure we've got some Fund 3 investors listening as well. We formed the company in 2007. In the beginning, it resembled more of a family office. But we built it because we believed we could build a better firm, better than any that we could find out there, big or small. And it was really about delivering a truly institutional quality product to the individual investor. And that was the beginning, and that still exists today. And that's, if you look at our mission, it's about transforming the way individuals invest in real estate. So we're very just passionate about the way we built the company, the mission, and very proud of what we've built today. We have invested significantly in every fund and every deal, and I'm proud to say that my partner and I are still the largest investors at Origin today. And we have more than 550 investment partners across our 3 funds and individual deals. And those investment partners are served by 25 Origin team members who are spread across 4 different offices. Our headquarters are in Chicago. Then we have offices in Dallas, Charlotte, and Denver that serve as hubs to those various regions. Our assets under management are approaching $1 billion. And in terms of strategy, it starts with really looking at growth and where can we find growth and position ourselves in front of that. And we're in some of the highest growth markets in the country, or the fastest growing markets in the country. We're in Denver, Chicago, Austin, Houston, Dallas, Raleigh, Atlanta, and Charlotte. And we recently expanded to Minneapolis, Nashville, and Phoenix. And beyond that, though, we're looking at the micro markets within these growth markets, and we're looking for the micro markets that we believe are going to be growing the fastest. So positioning ourselves in the path of growth within each growth market. Our strategy is really, we invest in everything from core plus to value add to ground up, and primarily office and multifamily, but we have done our fair share of retail and industrial as well. And what I do want to emphasize is that we are a hands-on manager. We are involved in the day-to-day. We buy direct. We do joint venture. But we have a team of people who focus on property operations. And we've had success over the last 10 years, a lot of it. Again, we are on our third fund. Our first fund generated a 28% net IRR, 2.3 multiple, and our second fund is on track to generate a 21% net IRR and a 2.1 net multiple. And we're in the process of investing our third fund, which is a $151 million value add fund, and we are currently today 62% invested in that fund. We have, if you're a Fund 3 investor, you'll like to hear this. We did send out this communication, but we have another 3 deals under contract, which will bring us to 87% invested by the end of Q1. And our investment philosophy, and this is for Fund 1, Fund 2, Fund 3, it will be true of QOZ as well. It's really about managing risk at every point of time in the life cycle of an asset. And we obviously have to make sure that we get it right on the front end. And it starts with identifying well-located properties in the right market, the right sub-market, and then buying them at a price that makes sense, a price where we can meet our cost of capital. It doesn't matter if we have the right property, but we're overpaying for it. And then lastly, it's about managing risk, leverage risk, debt risk, financial risk on that side. And we're big believers in leveraging appropriately. Our typical deal is leveraged with anywhere between 60 to 70% debt to equity. And it's those guiding principles that have gotten us to where we are. They'll be the reason why we continue to be successful in the long run as well. Why QOZ and why now? And this is these are kind of loaded questions, and a lot is embedded in here, and we wanted to answer this. When QOZ was announced, we didn't run out and raise a blind fund and said this was the most amazing thing since sliced bread. It really started with research and questions, and we know it's an incredibly favorable law, but the question is about, are the investments viable? And what we asked were 2 questions. Are the QOZ areas places we would invest regardless of QOZ? And in most instances, and I think this is maybe something we've heard quite a bit, because these are, in many cases, distressed areas, depressed areas. And in 90% of the cases, I would say they're not areas ready for investment, and not areas that we would feel comfortable going into today. Now, that is likely to change in some of these areas over the next 10 years, but I can only tell you that today we aren't looking in those areas. It's the other 10%, though, that really is intriguing to us, and areas that ironically perfectly overlap with our Fund 3 strategy, and in areas where we were already looking in the path of growth. And just to give you an idea of the overlap, one of the deals we just put under contract in Fund 3 is in a qualified opportunity zone, and we've been working on it for well over a year, well before the qualified opportunity zones were announced. And it just so happened that we were smack dab. Now, unfortunately, we won't get the benefit in Fund 3 of the qualified opportunity zone tax break. But the point of the story is just to give you an idea that we're already in these areas looking, and there are plenty of qualified opportunity zones that overlap with growth markets, the path of growth. good quality. I do want to note, though, that QOZ is viewed, or I should say QOZ deals are viewed through the same lens as your typical market rate deals. They have to stand up to the same investment and underwriting criteria and scrutiny. QOZ in no way makes real estate more valuable. And I want to emphasize that point because a lot of people are concerned about money coming into these zones and bidding up properties. We are as well. And there's a lot of reasons why we structured the fund the way we did. We believe that there is opportunity out there and that first movers will have an advantage. But ultimately, a lot of the money that's flowing into these $500 million, billion-dollar mega funds will find its way into the areas where we are looking for investment as well. The second question we asked ourselves is, how big is the opportunity and how long will it last? And, you know, this is something our team and we've been looking at for more than 6 months now, but we wanted to really make sure that we could invest enough capital to make sense of it on our own, and this wasn't going to be a one-off orphan deal or 2 orphan deals. And it's a difficult question to answer, but we have enough scale now with our first 3 deals and $100 million of need for equity that we believe it's a very viable opportunity, and our team is optimistic about what they're seeing in the market and the deals that are available today. So while we have a need for $100 million today, we do believe that's going to grow. And we certainly wouldn't have announced the fund if we didn't believe there was a 12 to 24 month opportunity in front of us. The fund strategy is easiest to find as what we call a build to core model. The fund will be engaging in ground up development opportunities that will be built and then held for longer than 10 years to take full advantage of the QOZ benefits. We will be engaging in ground-up development, and that's the riskiest phase of the investment. That will be the first 2 to 3 years. The majority of the hold period, though, will consist of owning a stabilized, institutional quality Class A assets or a portfolio of Class A assets. And these are 2 very different risk sets, and we know how to manage them both. The fund will use around 65 to 70% leverage overall. And one of the questions that came up is this a good time for development? I think we've gotten this question in virtually every fund, and people want the insight into timing. Are we in the 9th inning, the 8th inning, the 7th inning? We won't really know that for several years. That is the best answer I can give. I can tell you that the deals that we're underwriting today have to hold up to what's happening in the market. So where the interest rates are higher, where we see growth slowing, things like that, those all go into the model and factor into the returns that we're about to show you. What we do know is that institutional quality real estate, and this is all going to be institutional quality real estate, has never lost money over a 10-year period. And that's something that I think that people should understand, that we're building these Class A developments to a core profile. We're going to have between 60 to 70% leverage on these, which is a responsible amount of leverage. And these will be cash flowing quite nicely. So we understand that people may view development as a riskier, but keep in mind that 7 out of 10 or maybe even 8 out of 10 years of the hold will be in a stabilized core asset. So I'm going to move now into the Q structure and talk about how we solve the problem of not being able to fully quantify the opportunity set and how long it will last. Again, instead of raising a blind fund, we are using what's called a Q structure, and it's sort of this hybrid between a committed capital fund and a syndicated fund, if you will, or syndicated deals. Today, we know that we have $100 million in available opportunities, and we are going to call 100% of the first $100 million. These are going to be in $100 million tranches. And what happens is when we invest that first $100 million, tranche 2 actually moves forward into the queue. And when we grow the fund and find more deals, we will be calling capital then from tranche 2. And once tranche 2 is fully satisfied, then tranche 3 moves up and the same thing happens. And we can have an unlimited amount of tranches. And it really helps us size the fund based on the opportunity. And we believe that it's a better way of doing business because rather than raising a $400 or $500 million fund, if we can only put out $100 million, then we'd only be calling 20% from everybody. In this way, we can satisfy 100% of tranche 1 investors, and hopefully we will find enough deals to satisfy tranche 2 and 3. But this structure allows us the flexibility. The one thing I do want to be clear about is that there are no fees for joining the queue. Ben is going to talk about the summary of terms later, but I will let you know that one of the things we've done is we've gotten rid of the committed fee. So you can join the queue and be in a tranche, have your secure position, and not pay any committed fees during that period. He's also going to talk about how you get selected for tranche 1, 2, or 3. But in general, the priority of investing is that Fund 3 investors get priority first, and then the people who are on the wait list in the order that they signed up. So I do encourage you, if you haven't already signed up, to sign up on the wait list, because that timestamp of your wait list commitment is important for us as we bring commitments through the queue and then allocate them to the various tranches. Now I'm going to cover the pipeline of deals. I'm going to give a high-level overview, and more information on these will be available in the next few weeks. The deal in Denver is a 400-plus unit multifamily. It's anchored by a medical research facility. Our third fund will also be investing in this deal, and this deal was actually sourced for Fund 3. It required more equity than Fund 3 could put in, so it became a great opportunity for us to come in and use the QOZ fund to fund the remaining equity in the deal. Denver is a market we've been covering for about 8 years now. It's incredibly hot, and in the last 3 months, we have seen Equity Residential and 2 other REITs announce they are increasing their Denver multifamily portfolio. And in fact, Equity Residential left this market about 10 years ago, and the new CEO just decided that they want back in. So they'll be making a lot of purchases, and it's just a great testament to a growing market that we've been operating in for the last 7 or 8 years. The other project that we have under contract right now is in Charlotte, and these are 2 land parcels that we have under contract along the light rail line just north of the city. And we plan on building one project that's a 300-unit multifamily garden-level project in 2019, breaking ground on that, maybe early 2020, and then phasing in another 3 250-unit projects over the next 1 to 3 years in that. So it is a phased development. We didn't want to come in and build 4 developments all together and just oversupply the market. This is a tiered approach and making sure that we build one at a time and just manage our risk appropriately through about a 1 to 3 year cycle. When we talk about the path of growth, the Charlotte projects are exactly what we are looking for. These are transit-oriented developments right along the newly built rail north of the city. And one of our Fund 3 assets that we also just put under contract is a stone's throw from these assets. So we're excited about the Denver project. We're excited about the potential for Charlotte and the pipeline we've been able to build in the QOZ markets. Now I'm going to cover the timing of capital calls, and this was also a frequently asked question by investors who emailed us. People are curious about how much notice they're going to get. There's a lot of there's a lot of nuances that Mike covered about the QOZ law and how investors conform. And what we've done is built flexibility into our capital call process because everybody's tax situation is unique. Our role is to make sure the fund is compliant, and as an investor, you need to make sure that you are compliant. The 180-day rule means you have to invest in the fund within 180 days of the gain being recognized. Now, I'm not a tax attorney. This isn't tax advice. I'm just explaining how we made the fund a little more flexible to appeal to individuals' tax situations. But the capital calls and harvesting gains, they don't always match up. So here's how we built flexibility into the fund. If you look on the left-hand side, in December of 2018, we have a need for $25 million, and we plan on calling that. We also have a need in May, approximately May of 2019, of another $25 million. Now, for those of you who have harvested gains in 2018, the May closing may not benefit you at all. Your 180-day period may expire by that time. What we are allowing people to do is, if you would like to fund, this goes back to tranche one, we're using a $100 million example, so $25 million and $25 million would mean we'd need 50% of your capital by May. We will allow people to invest not only what is required in December, but also an optional funding to protect their capital gains to make sure that they get full QOZ treatment. And what that means is that if you've already harvested a gain and you need to invest it, we'll take that money. We'll take up to 50% of your capital commitment in December of 2018. The caveat to that is any money we take that we haven't called that is part of the optional funding will be deemed as working capital, and that is actually a term under QOZ law. And working capital, we're actually allowed to take this, and so long as we invest it within 31 months of taking the capital. If you look to the right-hand side, you'll see December of 2019. Now, that's the last period by which you can get the full QOZ benefit. I don't personally see that as a reason to invest at that time, because if you invest after 2019, your deferral, the benefit of the deferral decreases from 15% to 10%, and you can look up the individual law on that. So it's not a huge penalty for investing after 2019. But what we've done again is we've allowed this optional funding period. So if you do have gains that you've harvested in later 2019, you can invest those at that time period and get the benefit of investing those at that time period, even though we may not use them until June of 2021. From our standpoint, we just have to make sure that we're not taking capital that we're not going to be able to invest in 31 months. So we will communicate during that period to make sure that we can comply with the law to make sure that the fund is compliant as well. But these are some things that some of the flexibility that we're building in, and we know everybody has questions about capital call and how much guidance and things, and we will do our best to give as much guidance. What I've been telling people is that the best thing to do is harvest gains at the time that you receive the capital call, and we'll do our best to give 30, 60, 90 days of capital call guidance. The one thing I do want to point out is that any money that is funded as part of working capital, that's not part of the required capital call, that will be excluded from both the fees and the preferred return, and it will sit separately from that until the time at which the capital is either called or invested, and then the clocks will start ticking on that. So now I'm going to go over the fund returns, and what we've prepared here is a return analysis based on a $1 million investment in the fund of qualified opportunity zone dollars and non-qualified opportunity zone dollars. The fund net multiple is slated, this is on a pre-tax basis, and this is net of all fees, is a 2.6 multiple, meaning that if you put in $1 million, you would take out $2.6 million at the end of 10 years. The net IRR is expected to be around 14%. And we do expect that we will be able to return some money along that 10-year continuum through refinancing. There are still some guidance that is expected from Treasury, so we'll keep you posted on that, but we fully expect that refinancings will be allowed. Where this gets really interesting is when you look at the QOZ on an after-tax basis. The after-tax multiple on QOZ capital goes from a 2.6 to a 3.15, and the QOZ after-tax IRR goes from 14 to 17.3%. And I'll take you through this chart on the right-hand side to illustrate how this works. If you have, on the left-hand side, you see the column is non-QOZ dollars, and the right hand is the QOZ investment. If you're starting with $1 million capital gain, the non-QOZ dollars will only have $762,000 of investment power because you will have to pay the capital gains tax on that $1 million in the same year that you incurred the gain. So that we're using a 23.8% tax rate. That comes out to a 20% capital gains rate, and then a 3.8% net investment interest income tax. On the other side of the coin, the QOZ, you have $1 million of gain, but you're deferring the $238,000 for another 7 years till 2026, and Mike covered that a little bit. And you don't have to pay that, so you actually have the benefit of investing that $238,000. And the way I look at that is that's like a loan from the government at not only a low interest rate, it's actually negative, because when you pay it in 2026, if you move down a little bit, you can see there, you only have to pay $202,000. So it's an incredible tax incentive, but it doesn't stop there. If you move to the next line and you look at the after-tax investment, you see the equivalent, $762,000 versus $1 million. The year 10 value is simply the fund's return, the 2.6 multiple, times the amount of money that you were able to invest. Now, because you're a taxable entity on the non-QOZ side, you're going to have to pay capital gains tax. Your tax obligation at that point is going to be around $290,000, which means your after-tax value for non-QOZ money is going to be $1,690,000 versus, if you go to the right-hand side of there, you see the $2.6 million, but then you have to pay the tax liability in 2026. So net is that the QOZ money grows to around $2.4 million versus about $1.7 million for non-QOZ money. $700,000 in additional benefit from using QOZ gains when investing in the fund. It's substantial. I mean, it's 40% more in cash flow. The profit is well over 50%. And it's probably one of the best tax breaks I've ever seen personally, and it's one of the reasons why I'm so excited to take advantage of this as well. And I do want to be clear that non-QOZ money is perfectly eligible for this fund. You don't have to have QOZ money. It can be a hybrid. Obviously, if you have QOZ money, there's a huge advantage of investing that. And maybe I didn't emphasize this, but not only is the original tax deferred, but the entire QOZ investment grows tax-free, so that you don't owe any taxes except for the deferral amount. And that's one of the greatest things. So if the fund does a lot better than this, then your gains will be exacerbated even further. Now I'm going to hand it over to Ben, and Ben is going to cover the fund terms and then next steps and how you can participate. Thank you for your time. Appreciate it. Ben?
Thanks, Michael. Now that we've covered the fund in depth, I want to run through the terms of the offering. Like the rest of our funds, our two principals will co-invest at least $5 million of their personal wealth alongside investors. Also, like past investments, we're providing institutional pricing to individual investors. The fund will have a one-time upfront admin fee that will range from 0 basis points to 200 basis points, depending on how much capital you commit. There's a 50 basis point acquisition fee, and there's also a 150 basis point annual asset management fee. It should be noted there is not a commitment fee, so you won't be charged until your funds are invested. There's a 15% performance fee after a 7% preferred return, and a 50-50 catch-up is achieved. From an administrative standpoint, the fund will have a third-party auditor, and the fund will also have a third-party fund manager that will handle all contributions and distributions. It's important to note that the QOZ Fund is a long-term investment that is expected to last more than 10 years to reap the maximum tax benefits. There is not a liquidity mechanism. In terms of next steps, everyone that has indicated interest in the QOZ Fund will be contacted when the investment summary and the private placement memorandum are finalized in the coming weeks. As for fund capacity, everyone who expresses an interest will be assigned to a tranche based on when you indicated interest. We will notify you of your tranche position by the end of the year. Please note that current Origin investors will receive priority. If you have not logged your interest yet, then visit our homepage and register by clicking the I'm Interested button and filling out the short form. That concludes our webinar. Thank you for listening, and we look forward to partnering with many of you in the QOZ Fund soon.